Explain to us where Atlas Merchant is going and how Larry fits into that plan.
Well, Atlas Merchant Capital is investing in financials. That's kind of our space. Our flagship fund is focused on Europe and the U.S. We have investments now. We had our investment day yesterday with all of our investors, and we now have banks or broker-dealers in Milan, in Paris, in Athens, in London, in Bermuda, and 2 or 3 here in the U.S. Larry was the man I brought into Barclays in 2003, I think it was, Larry, right, from the Fed, and then JP Morgan is chief U.S. economist there. And he built the research and economics business at Barclays. The key was post the Lehman acquisition, when Larry combined the Lehman research department and the Barclays research department. He doesn't get enough credit for this, but in the 2 years following that integration, Barclays was #1 in fixed income and #1 in equity research by institutional investors. So getting this guy back to work with our operating companies and help them on the macro environment and in some of the research issues is just terrific.
So Larry, how are you going to help make money? That's a great resume. That's really impressive. And how are you going to help make money?
Yeah, well, the macro environment, of course, is pretty important in terms of where you're going to put your investments. I think the private equity space is an interesting space and very attractive right now with lots of liquidity and very low returns elsewhere. And financial services, it seems to me, you've had banks recapitalize. It's been now a decade since the crisis, and valuation's still very low, and even the regulatory environment's getting a bit better. So I think it's a great opportunity, great firm. Bob's a great builder of businesses. And again, I'm hopeful I can help add value with the macro analysis of the macro environment.
So we're getting our signals confused right now.
Okay.
Usually Brent, you're good at it. But this world is totally different than one you might have looked at in 2003 in terms of zero bound and sort of how often we'll touch it here in the U.S., in terms of where the ECB is going to be, and then how you value a bank stock, for example, based on these low and then negative interest rates. How do you do that?
Well, let's be clear. I came to Barclays in 2003. I didn't leave Barclays. It was over a dozen years, and the world's always changing a lot, and it's changing faster than it's ever changed. So one of the interesting things is, even since the financial crisis, even though that's 10 years ago, we've still got the ECB with negative yields. And Bob knows a lot more about obviously the condition of the individual banks, but negative rates is not great for banks. They're parking their cash at the ECB, and instead of getting interest, they're paying for it. The U.S., I don't have to tell anybody how much the U.S. has changed. We are now reversing over 40 years of U.S.-led free trade around the world, which in my mind has really helped propel global growth, along with the entrance of a lot of low-cost producers. And that's causing a lot of problems, this reversal period.
So Bob, I'm putting up a chart. We just put it up a minute ago about where exactly the ECB is, way down at the bottom in negative rates, further than the BOJ is. Can you make money in European financials as long as that's the case?
That in and of itself is a damper on any profitability of any financial institution. So we have to start with that. But Europe is, as Larry said, 10 years on from the crisis. The fundamental issue for European banks, in my mind, is really 2 pieces. One is they still have balance sheets that are not ready to start lending and to play their role in driving economic growth and lending to small businesses. And 2, Europe has still been hesitant to allow the development of a deep capital markets like we have in the U.S. So much of the risk ends up on the balance sheets of the banks. What we look for over there is, can we find institutions like Praxia, the bank in Greece, that doesn't have legacy loans? And if you can find a place to start without legacy loans and without legacy technology, the ability to bring the technology in and develop a digital offering is better than it's ever been for all the reasons we know around the development of technology. So banking can be a good business, but I don't want to the negative interest rates are a damper on profitability in any financial institution.
I do want to point out, we did have an IB a viewer comment on IB saying, congratulations to Larry, great hire, was a great train buddy. So clearly someone you rode the train with is watching and is super pumped that you're now at Atlas. So just to pivot off of that, we talk a lot about the negative rates being bad. Why would a bank want to give out a loan for that? But what's the demand side for loans? Is there the demand for it in Europe?
Well, they were hoping that with negative rates, people would start spending a lot more, and that's it. That really hasn't happened. There's no doubt that it's helped keep bond yields very low, along with the ECB purchases of European bonds, and that's helpful. But again, not, as Bob said, it puts a damper certainly on bank earnings. A lot of people expected the ECB by this time to raise rates back to zero, and what are they doing instead? Giving more funds to banks. They've reopened the LTRO program. So there's still a lot of problems in Europe.
So one story was that if the trade war between the U.S. and China is resolved, that Europe will pick it right up. That it's all Germany and everything's going to be fine. Do you buy into that?
It'll definitely help Europe. Let's not forget that Europe's a lot more dependent on trade for growth than the U.S. is. The U.S. 12% of the economy is exports. Germany's almost 40%. So no doubt the trade war is hurting Europe more, and the resolution would definitely help Europe more than it would the U.S. I do think that this will be resolved one way or the other before we get to the increase in tariffs on the extra $300 billion or so that the U.S. administration is planning to impose on the rest of imports, because those are final goods. So far, we're just doing intermediate goods like car parts and circuit boards. Once you start getting into clothing and iPads and iPhones and laptops, that's going to hurt the consumer a lot. I don't think that's going to happen heading into a presidential election year.
Bob, when it comes to European banking, it's not just monetary policy, it's also political and regulatory issues. I mean, when you look at Europe banks versus U.S. banks, we didn't recapitalize the way we did in the United States, didn't do it in Europe. And also, you're not getting consolidation because you don't really have the mechanism to get consolidation. To go back to Europe for a second, can you really get done what you want to get done at Atlas Merchant if you don't address those two issues?
So it goes back. David, you're absolutely right. And it goes back 10 years to the U.S. Put in the TARP program, and they quickly had a process to encourage the banks, or really force the banks to clean up their balance sheets. And when you look at the situation in Germany with Deutsche and Commerzbank, it's really that the banks have not yet cleaned up their balance sheets. And that's the process that we need to go through more than anything. I think the second piece, and it is a bit political, David, is there's a reluctance to encourage a development of a deep capital markets outside of banking. And so much of the loans, so much of the corporate risk ends up on the balance sheets of the banks. So when there is a slowdown in the economy, or there is a Volkswagen crisis or something like that, it immediately slows down lending. Where with the U.S. banks that are able to put much of that lending into the capital markets, they don't have that halt to their business when something hits the market.